Interest rates dropping. I haven't heard any news about the Fed, but interest rates have dropped. Give a little explanation of what's going on.
Well, so many people think that the Fed controls long-term interest rates and the interest rates on the mortgages that we get to buy our investment properties. But the Fed does not control interest rate. What the Fed controls is called the Fed funds rate, and that indirectly affects long-term interest rates. And case in point, the last 2 months. If we go back a couple of months, the average interest rate for the 30-year fixed rate mortgage, according to Freddie Mac, was 7.79%. But guess what? If you look at the average interest rate for a 30-year fixed rate mortgage, according to Freddie Mac, today it comes in at 6.61. Did we say sixes?
We said
sixes. Okay, so we've dropped. Mortgage interest rates have dropped on average about 1.2%, which means a lot to us as investors. But guess what hasn't changed?
What hasn't changed?
The Fed funds rate. So the Fed has actually not decreased the Fed's funds rate. So this is a great time, because when interest rates drop, that makes our returns on investment higher. That same asset, lower interest rate, increases the return on investment. We're going to do a little deep dive into that today. But it's also a great learning moment to see that this can happen, that this indirect relationship is real, and that you can actually have long-term interest rates come down even if the Fed funds rate stays constant. Because then you can start to think about, well, what actually would happen to long-term interest rates if the Fed funds rate, and when the Fed funds rate actually does come down, right? We can start to think of a world where interest rates are actually lower than 6.61%, but you don't necessarily have to wait for the Fed to take that action in order to make it happen.
Sounds good. All right, JC. Let's, what's going on here?
Yeah, so here's just in graph form, pull straight off the Freddie Mac website. This shows either the 30-year fixed rate mortgage or the 15-year fixed rate mortgage. We'll focus on the 30-year because that's most often what's quoted. But you can kind of see what interest rates have done. Over the last year and a half, you can see that interest rates have gone way up. We got close to that dreaded 8% figure out there. And, you know, since then, you've probably read a lot of articles. You've probably heard a lot of talking heads talking about how the question is not how much more is the Fed going to raise rates. The question is now, is the Fed done raising rates? And when is the Fed going to start lowering rates? And when the economy, the investment population believes that the Fed rate hikes are at an end, what they start to do is to create more demand for investments like mortgage-backed securities. And a mortgage-backed security is just a fancy term for the mortgages that we pay interest on. The investor on the other side receives that interest rate. So there are investors on the other side who make a decision, is it something they want to lend their money out and invest in that investment. So when the Fed says, hey, listen, we're probably done raising interest rates, which is a lot of what they're signaling now, the opportunity for an investor to lock in a high, what they perceive to be the highest mortgage-backed security return on investment is there. And so you see a lot more demand for the back-end investors of these mortgage-backed securities to come in, buy that asset, invest in that asset. And ultimately what that does is it drops your interest rates because there's more demand on the back end, which we don't normally think about. And so ultimately that's the biggest movement here. And that's what you're seeing. That is, in essence, why long-term interest rates have been dropping, even though the Fed hasn't changed anything yet. There's more demand for that investment.
Got it.